Welcome to the InterMarket Analysis video update. This is a weekly video where we look not only at other stocks compared to the S&P, but we look at other sectors, we look at other markets outside of the stock market, just in case by looking at these markets, we can get some clues because no market exists in a vacuum. Sometimes something that's happening way off in a different market can have an impact on stocks. Another area that I go through in this video is a pretty extensive study of growth versus value. When the market's really going up, growth is outperforming value. When the market is either going sideways or down, often value is outperforming growth. So we want to keep an eye on that and look at it from a number of different angles. We also look at other markets way outside of the stock market because they can have an impact. And I also go through a valuation, not only looking backwards at earnings reports that have already been released that are compared to the current price of the S&P, but what do those forward-looking earnings reports look like to justify stocks either going up or down from here? This is being prepared for Monday, October 7th. And last week when I did this video, I was actually in Jerusalem, Israel. And right after recording this video, things turned pretty bad there. And so the decision was made to leave the country 3 days before the scheduled time for leaving. And I ended up making it out about an hour before things really went crazy there. So I didn't get a chance to complete the deep dive video or the what to watch video, but now I'm back where I have been residing, and so I hope to be able to do all the videos over the weekend. All right, before I get going into that, there's a thing called the SPXInvesting Program. It's a program I have developed. It's an educational program. Right now it's free. It's going to be locked down, and there will be a charge starting in 2025, but I want to give folks a chance to look that over. There are additional videos that I post there that I don't post on YouTube or Rumble. If you have any questions, here's an email address where you can contact me. You can also go to the website by hitting a link below this video, and there's also a video that talks about the program. So see if that's something that is of interest to you. This video that I'm doing right now, the InterMarket Analysis video, it's just one of the weekly videos that I do. I do a number of different weekly videos, but all of these tie into the daily video. So if you really want to figure out what's going on with the market and subtle little changes as they're happening, the daily video is really what you should focus on. First area that we look at is S&P 500 valuation. First, we look back at earnings reports that have already come out, and we compare them to the current price of the S&P 500. And when the PE ratio was first developed, its price to earnings ratio, they came up with static numbers. When we're at 10 or below, either an index or a stock or what have you, is considered to be inexpensive or cheap. Then when we go from 11 up to 19, that's considered to be fairly priced, and that's the line you see in blue. And when we get at 20 or above, then the market is considered to be expensive or overvalued at that point. Looking at this chart, the black line is the current value for the S&P, and we're way above the red dashed line. I break it out down here below, just showing you how far above we are from the red dashed line here. So the market is considered to be expensive. But if you look at this, we've been expensive for years now. So we don't use this as a timing mechanism. We just look at this to get an overall idea of what is the market looking like. Also, to get a little different perspective, going back to 1980, different events that have happened along the way and what the valuations were compared to price at that time. And here you can see again that we can spend years above this red dashed line. Another variation of this is called the Shiller PE ratio, the Shiller ratio. That's good. Where instead of looking at earnings as they're released, Robert Shiller came up with a method to say, let's smooth this out over 10 years of earnings and see if that gives us any more insight. What we can see over here is a chart of the Shiller PE ratio. It's coming in at 36.94. Well, what does that mean? We can see historically that we're pretty high right now, but not as high as we were back in the year about 2000 or so. when we had the dot-com boom and then bust after that. And we're coming up to a level that was reached back in about 2021. To get another perspective, we look at the median and the mean, kind of like the average price over a period of time. And we're just a little under 16 for the median and a little over 17 for the mean. So looking at just these numbers, we can see that yes, on a historical basis, we are overvalued, but we've been overvalued for years now. The market doesn't do that. It looks forward. What are analysts projecting as earnings looking out into the future? Well, we have this purple line here, and this is the Mega Cap 8. You could call it also the Magnificent 7, the Illustrious 11, whatever you want. But we're coming in at 29. That is a really high PE ratio, but folks don't seem to mind that. These big companies, they're big for a reason, and investors really like them, and their earnings look good going out into the future. So folks don't mind buying a stock that's already considered to be expensive because they're thinking that earnings will go up and it will help the stock price to actually go up as well. So sometimes the real high flying stocks, they have a really high PE ratio. And this has been this way now for a long time. You can go back into 2017 or so when this purple line started to break above the other lines. What we focus on here is the S&P 500 forward-looking PE ratio. That's coming in at 21.4. Yeah, it's been higher than that before, but usually when we get above 20, we get a little bit nervous there. We're wondering if the current price of the S&P is justified by the earnings going forward from here. Now, if we see a decline with the S&P, then this red line will come down. But for right now, we're considered to be expensive, even looking forward. But I don't use this as a timing mechanism. I use technical analysis. This is just one aspect of what we keep in the back of our mind to say, okay, the S&P is more overpriced right now. We look at the mid caps and the small caps, they're closer to that 15 range. So they're more fairly priced. But then you have to look behind the mid caps and small caps. Are they earning a lot? Are they growing? Do they have a lot of debt? We need to look beyond just this particular value to get an idea, okay, is that a good investment or not a very good investment? Then we look at growth versus value. Now, here is a growth index all by itself. And when you look at it, the blue line's above the red line. This is a 50-day moving average above a 200. When the blue line's above the red line, that means we're in an uptrend and price is above both the lines and the lines are going up. So growth all by itself is looking pretty good. We also look at value, kind of going sideways right now, but also in an uptrend. When we do our analysis, we're doing ratios between growth and value, where here we have growth versus value, showing how growth has been outperforming value. And then I do an inverse of that because they're calculated in a slightly different way. This is showing how value is now back to underperforming growth. We were bouncing back up. And this was causing some concern. This was the big downturn at the beginning of August, and then the market was afraid, uh-oh, the economy's falling apart. So we saw value starting to really go up. Well, now it's starting to come back down. And we look at this a number of different ways. A longer-term ETF, growth versus value, showing how we had been coming down with growth, outperforming, but now we're starting to go back up. Here's an inverse showing how value continues to underperform growth. And then we look at some other indexes longer term here, showing how growth is outperforming value and how value is underperforming growth with a little shorter time horizon, but we're still looking at the same basic thing. And then we look at a growth versus value index again here, showing how growth is outperforming. So we're seeing confirmation when we just do growth versus value with ETFs, with indexes, with different kinds of indexes. So that's positive for the market right now. Then we look at some ETFs. This is showing how value is underperforming growth. It was starting to come back up, but now coming back down. And then we look at growth versus value. And I show this chart in every daily video because we want to keep a close eye on this. We were seeing a real breakdown between the growth to value ratio here. We were dropping below the 250-day moving average. Well, now we're starting to bounce back up. We'll be even more positive if we can come back up through the rainbow and actually go above the rainbow that's plotted here. Then we break this down and look at small caps. Not really doing all that well with their growth to value. Mid caps also not very well these days. We're seeing an improvement here with the S&P growth of value, and I focus on the S&P 500 and all the strategies that I teach and all the technical analysis that I do ultimately goes to the S&P 500. This is showing an improvement. We would like to see more follow through with this, even surpass this previous high set back in early July. That would be even more positive for the market. We keep an eye on inflation. On top, you have a monthly chart of the commodity index here, and it's pretty much going sideways. Now, we went up a little bit here, but the moving average itself is pretty much going sideways. And we keep an eye on another ratio of inflation versus deflation, showing how this is going down. That's more deflationary. So inflation doesn't seem to be a problem as measured by this chart. We look at a daily chart of the CRB index, which is in a downtrend, but it was really bouncing up. And a lot of that, if you look over here, 39% energy, that's because of things going on in the Middle East where I just got out of, thankfully, alive. And oil is starting to go back up. And that could put some pressure on stocks. Now, oil can go up by itself if the earnings for those companies are also going up. But if oil's going up for geopolitical reasons, that puts it in a whole different context, and that may end up being negative for stocks. So that's why we saw a bit of a bounce up this last week with the CRB index. And we look at the Baltic Dry Index, not really getting all that much. As a general rule, when this is going up, that's more inflationary, costs more to ship products, specifically in the Baltics, the sea way up north there. Well, we've been just treading along, not really moving up, not really moving down right now. So we're not getting a lot of insight from this chart. We keep an eye on aluminum, which is still in a downtrend, but it did bounce back up recently. Wheat is also in a downtrend, but bouncing back up a little bit lately. Corn bouncing back up, but still in a downtrend. Fertilizer, which this is just a 3-month chart here. We're not really seeing anything all that drastic right now. This is what we're watching. Oil. It had got down into the 60s. In fact, it got all the way down to 65. Now we're up into the mid 70s. If this keeps going up because of geopolitical tensions, that could bleed through and actually be negative for stocks. And we look at a gold to oil ratio where gold has been really outperforming lately. That's when you see this ratio going up. Well, gold, it's doing okay, but oil has really been shooting up lately. So that's why we're seeing this ratio coming down. We also look at the correlation between the 10-year yield, which has been going back up now, and oil's been going up. So they have a fairly strong relationship, meaning they're going in the same direction at the same time. If one's going up, the other one's going up. If one's going down, the other one's going down. Keep an eye on gas. Of course, they're trying to keep prices really low now since it's an election year. Heating oil also coming down. That's also an election year issue. Natural gas just chopping around all right now, but still pretty much in a downtrend. Then we keep an eye on diesel. This is for trucks like 18-wheelers and railroads and stuff. Now, this is the spot price. This means the cash price right now instead of the futures, which look out into the future to see what the price is going to be somewhere down the road. But this did bounce up just a little bit, but overall it has been declining. That's not inflationary right now. We look at copper. This is known as a barometer of the economy. Typically, when copper is going up, the economy is doing better. And we've had some pretty friendly economic reports lately suggesting that we may not go into a recession, and copper likes that. And so it's been starting to go back up. And we look at a copper to gold ratio where copper's been going back up and outperforming gold lately. But when you look at the bigger picture, copper's been underperforming, or to say it another way, gold has been outperforming. And we look at a longer term chart of the copper to gold ratio. That's the black line that you see here. And for the most part, it's been going down, even though it's bounced back up lately. And then to give it a little more context, we look at the drop in the 10-year yield in red and the 2-year yield in green. But these have been going back up a little lately as this ratio has been going back up. So we want to keep an eye on this. We'll look at gold, the ETF. I don't look at the futures contract for this video, where we're pretty much been going sideways after hitting an all-time high. Silver, also, it broke out and set a new intraday high, but not necessarily a closing high here. It's also in an uptrend. We look at the closing value for gold on top, the closing value for silver, which has gone up lately, and we see that there's a pretty strong correlated relationship between gold and silver. Now, that may just go, wait a minute, yeah, gold, silver. I mean, there's a song in Rudolph the Red-Nosed Reindeer, silver and gold. Don't they always go together? Yeah, but sometimes the correlation gets out of line with each other. Right now, it's a fairly strong correlated relationship. We look at a gold to silver ratio on top. So when this is going up, that means gold's outperforming. When this is going down, that means silver is outperforming. And believe it or not, we plot it against the US dollar down here and then look at the correlation between the top chart and the middle chart. It had been a little stronger, but now it's starting to weaken a little bit. If we drop down below this 0.25 area, that's where we're more or less neutral. And that's probably due to some of the geopolitical tensions that are going on currently. The dollar, which is in a downtrend, but it came all the way down to this 100 level and just bounced ferociously off of that level. And if the dollar keeps going up, that could pressure stocks. The stock market likes a weaker dollar. And we look at another chart of the dollar where it was still kind of hanging out below this downward sloping trend line. Well, we broke up above that this past week. We look at the euro on top and then the dollar index, and these are almost a mirror image of each other. Even though this is the dollar index, which includes other currencies, the euro is such a huge part of the dollar index. That's why it looks like these are the mountains and this is a reflection off of the lake, or almost a mirror image there. We keep an eye on the Japanese yen, which had been in a downtrend compared to the dollar. Now it's starting to go into an uptrend. The euro is still in an uptrend compared to the dollar, and then down below the dollar index. Now, when I break those out, the euro against the euro is still outperforming. Then we look at the Japanese yen, which back in September had a golden cross here. Lately, it's been falling back, but it's still in an uptrend when compared to the dollar. And here is the euro again, if you didn't get it the first time. This this was a okay, this is the current chart here. As the dollar's been going up, the euro's been coming down, but it's still in an uptrend. We look at some different indexes here. And even though they're on different scales, we have the weighted version of the S&P 500. And when the big stocks do whatever they do, has most of an impact on the S&P 500. So if the big stocks like the Magnificent Seven stocks, if they're really doing well, the S&P really goes up. If they're doing bad, the S&P really goes down. Well, to make it a little more fair, we compare that to an equal weight where all stocks are treated the same. And we're seeing, even though, like I said, they're on different scales, we're not seeing a real disconnect between the two right now. And this suggests that the rest of the S&P 500 is doing better than the really big stocks right now. We look at a ratio between the two. This also confirms that. When this is going down, that means the equal weight is underperforming. It started to outperform, and lately we've been just chopping around as both have been holding up fairly well lately. Then we look at stocks as measured by the S&P 500 and the CRB index, which is commodities, showing even though commodities were up and we pulled back a little bit, stocks continue to outperform commodities. Here's an inverse of that same chart showing how commodities are underperforming. We look at the NASDAQ 100, which is now underperforming the S&P 500. The NASDAQ 100 has the big high flyer stocks, and they've been lagging lately. Well, the S&P 500, it has 503 stocks. It not only has the high flyer stocks in it, but it has a bunch of other stocks that are holding up a little bit better right now. And so that's why we're seeing this ratio actually in a downtrend. We'll look at the S&P 100 compared to the S&P 500. It had been in a downtrend, but the big 100 stocks are starting to show some improvement, and we could see a golden cross here with this ratio. The NASDAQ compared to the S&P 500, where the NASDAQ is actually underperforming the S&P 500, and we've seen a recent death cross here. We look at the NASDAQ 100 and show how it's underperforming the rest of the NASDAQ. So the broader NASDAQ is actually doing better now and performing better than just the NASDAQ 100, which is not the way it was back in 2023 and into 2024. We look at the mega cap stocks, the real big stocks, and compare them with the equal weight index. And this is pretty much going sideways right now as they're both holding up fairly well. The small caps still underperforming the S&P 500. It looks like we were going to have another breakout. They had a good day on Friday, but they just shoot up and then come down, shoot up and then come down. It's like a lot of false signals that are generated with the small caps. Here's another look at that. The red line is the ratio between the S&P and small caps. And to give it some more context, the blue line here is the S&P 500. We look at small caps to tech. And we've been chopping around lately because tech has been lagging lately. It really led things higher. When this ratio is going down, that means tech is really outperforming. Well, lately we've been chopping more or less sideways with this ratio. The big software companies showing a little bit of strength lately and in an uptrend. Robotics and AI ETF doing really well. When you look at it by itself, it's actually above the rainbow. It hasn't broken out to new highs yet, but it's looking okay right now. But when you compare it to the tech sector, which is lagging, the robotics and AI ETF, it's underperforming. It's inside the rainbow. It's not really breaking out the way you would think it would. The mega cap stocks doing quite well, pulling back, not setting a new high yet, but still above the 50-day moving average and the 50 days above the 200. These are still looking strong, but they're not really breaking out to the upside the way they were earlier in the year. Dow Jones Composite Average, which is the Dow, which set an all-time high on Friday, the transports, which have been going sideways, and the utilities, which have been strong lately. So this index, when you take it all together, is doing quite well and just coming off of recent all-time highs. The Wilshire, another broad market measure, didn't set an all-time high on Friday, even though it was up almost 1%. We did set a new all-time high in the previous week here, but this is looking good for the broader market. And then another broad market measure, not an all-time high, but still looking really solid with the total U.S. stock ETF. Low volatility stocks, which continue to be in a real solid uptrend. And these are the more defensive stocks. They tend to hold up better when the market's under pressure. But we've been in a solid uptrend for all of 2024. Where we get some insight is when we compare it to the S&P. It's still underperforming. Now, it was starting to bounce back up as the market was concerned about the economy, but now it's starting to come down. However, we've just seen a recent golden cross with this ratio, and that could be negative for the market, but we're not seeing an awful lot of follow through to this point. Then some other stocks. Here's the advanced decline line. Looking good here across the board. We have the NYSE common stock, S&P mid caps and small caps. Small caps bounced off the moving average, but all of the other indexes are above an advancing moving average. That's positive across the entire market. We look at traditional Dow theory with the Dow setting a new all-time high, the transports just going along sideways, and the utilities pulled back, but they've been really strong as of late. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming the transports. And we look at another ratio of the transports showing how they're underperforming the S&P 500. Here's the transports all by themselves, just going sideways, not breaking up, not necessarily breaking down currently. We look at the relationship between the S&P and the transport index there, and it's getting a little bit weaker, but it's still in this red area, meaning there's a fairly strong correlation between the two. Then we change Dow theory up. Instead of using the Dow, we look at the S&P 500, which is not back to an all-time high yet, but just recently set one. And we, instead of using the transports, we use the NASDAQ because now we're a tech-based society instead of a railroad-based society. Where we're still not coming back to an all-time high here. This is a little bit of a negative divergence. We're breaking out with the S&P. We've not come back yet with the NASDAQ. We break it down a little further with the equal weight version of the S&P, just coming off of setting a recent all-time high, not setting an all-time high yet. Now, this is still looking good, but when we look at the QQQ equal weight ETF, we would like to see both of these breaking out at the same time. The FANG index still has a ways to go to get back to its all-time high, but it's still looking positive. And we're still below this shorter-term trend line with the FANG index, but we're above this longer-term trend line, so support has been holding. ARK is still in a downtrend, and it was up on Friday, but it's just been, at best, going sideways. And that's really disappointing for a lot of folks. And then we look at stocks outside of the US where they're just coming off of setting a recent all-time high. But when we compare them to US stocks, this is the SPY to world stock ratio. We did come down a little bit, but now we're starting to go back up just a little bit. We bounced off the 200-day moving average with this ratio. Then here's a monthly chart of the S&P 500 to global stocks in Europe, Australia, Asia, and the Far East. Still looking good with this ratio, meaning that US stocks are outperforming. We're starting to turn up slightly. Now, this is a monthly chart, so it takes a while for this percentage price oscillator to move. We had been going sideways. Now it's ever so slightly starting to go back up. Look at bonds. This is the 7 to 10-year bond ETF. This is bonds based on price, where we had been going up really strong, going sideways. Now we're starting to fall. Now, when this goes down, that means interest rates are going up. Here's the total bond ETF, also pulling back now, but still looking pretty solid in an uptrend. World bonds pulling back as well, but still in an uptrend. And then we do a monthly look at the stock to bond ratio. When this is going up, that means stocks are outperforming bonds longer term. This is a daily chart showing how bonds are underperforming stocks. So on this video, we get a daily and a monthly chart. In the weekly video, I show a weekly version of this where it also is showing bonds are underperforming stocks. High yield bonds. These are junk bonds just coming off of recent all-time highs. These are more conservative investment grade bonds, also pulling back, but still looking pretty solid right now. We do a stock to bond correlation, pretty much neutral for the time being. We look at corporate bonds, pulling back, but still in an overall uptrend. And we have some fib lines on here, but we're not close to these for the 10-year yield. This is a long-term look at the 10-year yield where it had really been coming down. This past week, it really started to go up. We climbed almost 0.25% with the 10-year yield from Friday to Friday. And that's a little bit nerving, but the market doesn't seem to matter. They don't really care right now. Then we do another Fibonacci retracement study here with the 30-year yield, not really close to any of these lines. Then we do a ratio between stocks and the 10-year yield. Even though this is pulling back right now, we're still showing how stocks are outperforming. We look at riskier bonds like junk bonds and compare them with more conservative bonds. And we're kind of at the underside of the rainbow here, but we really shot up lately. We want to keep an eye on this because interest rates are really starting to shoot back up. Are they going to get under control? Is that rise in interest rates going to come through and actually have an impact on stocks? Junk bonds right here looking pretty good all by themselves. And when we compare junk bonds to more conservative bonds, we were coming down. We actually saw a death cross with this ratio, but this past week we saw this really shoot up. And so we want to keep an eye on this area. And here's a daily chart of the yields, which show they had been coming down. Well, they really started to shoot back up. We'll see if that matters to the market. It didn't on Friday, but at some point it probably will if interest rates keep going up. Here's a weekly chart of yields in the US, UK, and Germany, where they all went up, and also Japanese rates went up as well. We look at the volatility of bonds. That's measured by the MOVE index on top, and then the volatility of stocks, which is the VIX. And we see that there's a pretty high correlation between the top chart and the middle chart here. So this doesn't measure price. If anything, it would, if we see these both really going up, that probably means bonds are going down based on price and stocks are going down based on price. But this doesn't really measure direction. It just measures the correlation between the volatility of stocks and bonds. We look at the S&P 500 and compare it with short-term bonds, 1 to 3 years. Looking really good here, but not breaking out to a high at least yet, at least a new high. But we're above the rainbow. That's good. That means stocks are outperforming bonds. Then we look at the S&P 1500 and also compare it with short-term bonds. Looking pretty good here, above the rainbow. And we look at another broad market measure and go a little further out with 3 to 7 year bonds, also looking pretty good with stocks versus bonds. The tech sector showing some improvements, trying to come outside of the rainbow here when we look at the tech sector to 3 to 7 year bonds. And when this is going down, that means bonds are underperforming stocks. And if you're more positive on stocks, you like to see this ratio going down. Here's a monthly chart of the 30-year price of bonds where we finally broke above the moving average, and the moving average is starting to turn up. Now, we pulled back lately, And then on bottom, we have the long-term bond to commodities, showing how the long-term bond price is outperforming commodities. Different sectors. We look at the material sector and all the different sectors here. There's 11 of them that make up the S&P. And then we compare them to the S&P 500, where the material sector has been doing quite well, even though it's pulled back lately. And it's in a downtrend still. It was showing a real improvement, but now it's pretty much chopping sideways when compared to the S&P. Communication. This is one of the growth areas, almost setting a new all-time high here and doing quite well by itself, and showing some improvement along the way here when we compare it to the S&P. Not really breaking out above these previous levels here, but we are at least going up for right now. Energy, which really had been going down, and now we're seeing it go back up, probably due to geopolitical reasons. But when we compare it to the S&P, it's still underperforming, even though it bounced back up this past week. Financials. We want to watch the financials because they were looking good in 2007, and then we had the great financial crisis in 2008. And we could, back then, I got some clues by looking at charts like this. Right now, we're hanging in there. It looks like things are doing okay by themselves. And doing okay here, we just saw a recent golden cross with the financials to S&P ratio. But for this to continue to go up would be more positive for the market. Industrials also looking pretty good when you look at them all by themselves and showing some improvement here. Now that we are still in a downtrend here, but we could see a golden cross with this ratio if the industrials continue to go up. And that's more economically driven. If the economy is looking stronger, the industrials tend to look better as well. The tech sector, the real darling, the thing that everybody loves. Not at an all-time high here, but still in an uptrend. And pretty much chopping sideways, but in a downtrend when compared to the S&P, as the tech sector has been lagging since we hit that all-time high back in the middle of July. Staples, toilet paper, toothpaste, really in a solid uptrend by itself, a more defensive area of the market, but it's been pulling back. It came down to its 50-day moving average all by itself. And we're seeing an uptrend here with this ratio, but it's really been declining lately. If this is going up and staples are outperforming, that means the market's getting more defensive. If this is going down the way it is right now, that means the S&P is getting more offensive, which means it's usually more positive. Real estate, which really was going up on the hope that interest rates were going to come down, it's been under a little bit of pressure lately too, but still above its 50-day moving average. And it has gone in an uptrend compared to the S&P 500, but lately pulling back as interest rates have been going back up. Utilities, and again, this could be taken as defensive. That's historically what it's been. But now that you have things like AI and crypto mining and all the things that, EVs, maybe utilities are more of a growth area now because of this switch over to all the green stuff. Well, they're looking really solid all by themselves. And when we compare them to the S&P, they've been performing quite well, actually outperforming. We look at an S&P to utilities ratio. Excuse me. When this is going up, that means the S&P is outperforming. When this is going down, which is kind of what it's doing right now, that means the S&P is underperforming. To be more positive, we want to see this ratio going up. Healthcare, another defensive area, actually broke down below its 50-day moving average and really starting to underperform again when we compare it to the S&P. So this had been a concern to us as it was going up because healthcare is more defensive. The fact that this is going down could be more positive for the S&P. Discretionary, the thing that makes life fun, has been doing a lot better lately all by itself and actually still in a downtrend compared to the S&P, but showing some improvement. Tesla is a big part of this. Semiconductors, a massive part of the tech sector. Came all the way down, broke below its 200-day moving average, coming down to its 50-day moving average. We were in danger of seeing a death cross. As long as we can stay above these lines and continue to go up, that would really help the tech sector. And it's still underperforming, though, when we actually, energy is underperforming when we compare it to the tech sector. Even though energy really bounced back up for geopolitical reasons, overall, energy is underperforming here. We look at growth stocks versus bonds. And we were seeing some weakness here as the market was getting more defensive. Here was the big down move at the beginning of August that freaked the markets out for a couple of days. Now we're starting to bounce back up, and this would be more positive for stocks if it kept going up. The tech sector to the 10-year yield pulling back, but still in an uptrend, showing how tech is outperforming. This is an inverse of that same thing, how the 10-year yield has been underperforming the tech sector. We look at discretionary versus staples, and we want this to go up if we're more positive on the market. The fact that this was going down and it's still in a downtrend is a little bit of a concern to us. Staples versus discretionary in an uptrend compared with this ratio, but lately really pulling back. And gold to the S&P, not really breaking out. Both have been having a really good year in 2024, but we were really breaking out with gold to the dollar. But with gold kind of going sideways and the dollar really going up, we're seeing a little bit of a tick down with this ratio. High leverage loans. This is still looking solid. That bodes well for the economy. The NYC composite just coming off of setting an all-time high, a broad market measure. All stocks, which looks at US stocks and international stocks, not at an all-time high here, but still looking quite strong. Emerging markets showing a lot of improvement here. And some folks are wondering, is now the time to get into these markets? The Japanese Nikkei, not at an all-time high, but not very far away from it. The micro cap stocks, the small stocks, they're also in an uptrend. And we look at the S&P and the home builders ETF, and then down at the bottom, we see the correlation is still pretty strong. We look for divergences here. When one's going in one direction and the middle chart's going in the other direction, that's when we take note of this. So we're not really getting any insight from this chart. Bitcoin is still in a downtrend. It came down to its 50-day moving average and has been able to bounce off of that, at least so far. And then this is a longer term look. Look how big China just spiked up. The Chinese government came in because the economy in China is really having some problems. And so the Chinese government came in and they lowered interest rates and they made money more available. Their market was just going in the toilet. Well, after they announced all these things, it's really been bouncing up lately. We're also seeing an uptrend in emerging markets in Europe, trying to see an uptrend here in Japan, and we're still in an uptrend here in the US. InterMarket Analysis, gold doing the best, followed by stocks, and then oil really shot up here. Green is the dollar, and now bonds have dropped back to negative year to date based on price. We look at some correlations. The S&P to the dollar, neutral right now. S&P to oil, kind of coming into this neutral area, but a slight tendency to go in opposite directions. We're going to be watching that if things escalate in the Middle East. The S&P to the 10-year yield, also neutral, but starting to go back up just a little bit lately. The tech sector to the 10-year yield coming down, almost getting into that neutral area. We're possibly seeing some kind of a shift in the market right now. And the S&P to the 2-year yield also, even though it's going up, we're still neutral with this relationship. Then we look at some long-term charts. Here's a monthly chart of the NYSE composite, just coming off of an all-time high, and the momentum is still positive. And that bodes well for the long-term outlook of the broad market. Here's a daily chart. We're still going up with the NYSE record high percent index. That's positive as well. And we look at another monthly chart of the S&P, still looking good above its moving average here. This is a 12-month, well, it's a monthly moving average here, so it measures a year. So this is a very long-term chart. We are rolling over a little bit here with the PPO. We're a little bit concerned about that. We want to see more strength to the upside if we want to remain more positive. Then we look at the S&P on top. This is a daily chart, and then we look at a daily ratio between stocks and commodities, showing how stocks are outperforming. There's a monthly chart showing how stocks are outperforming global stocks right now, but we're still pretty much flat when we look at the momentum oscillator that we use here. Then at the very end, I go through all the things that are positive, and my definition of positive is when the 50-day moving average is above the 200-day moving average. And we have a pretty long list here. Growth and value by themselves. Copper, the British pound and the euro against the US dollar, the Japanese yen to the US dollar, gold and silver, the big software companies, the mega caps, the FANG index, the low volatility ETF by itself, it breaks down when you compare it to the S&P. Staples are in an uptrend, the Dow Jones Composite Average, bonds based on price, all the different types of bonds that we look at are still in uptrends. The tech sector and semiconductors, high leverage loans, that's more to look how the economy is faring right now. That's positive. The Dow, the NYSE Composite and Wilshire, which are broad market measures. The NASDAQ and NASDAQ 100 are in uptrends. The mid caps, small caps, and micro caps. All stocks, and then emerging markets. So we're looking pretty solid, pretty positive across the board now. Then when the 50-day moving average drops below the 200-day moving average, that's when we're negative. The CRB index, even though it bounced up this week, it hasn't changed trend there. The dollar bounced up, but it hasn't changed trend. ARK is still in a downtrend, and Bitcoin is still in a downtrend, even though it's been bouncing up a little bit lately. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.